be on the roads for the holidays or planning a family trip, a rental car could make your life easier. But do you know the right way to shop for the best deal? Janet Marcantonio has some tips in Saturday Savings.
If you're planning on renting a car for a family trip, comparison shop the prices of automobile rental agencies first. Prices can vary widely, and there are deals and specials to be had if you ask the right questions. First, ask for discounts available to members of affiliate organizations such as AAA, the AARP, and the frequent flyer clubs of most major airlines. Most offer a 10% discount. In addition, at any given point in time, an automobile rental agency may have a special in conjunction with a specific frequent flyer program, so be sure to give your member number for every program you're a member of. You can save anywhere from 10 to 50%. Finally, check your personal automobile policy to see if it includes coverage for rental cars. If it does, you may not have to pay for the optional collision insurance coverage offered in the automobile rental agency's contract. I'm Janet Marcantonio, and that's your Saturday Savings tip.
Still more ahead on taxes.
Chances are you're not thinking about tax-saving ideas during this busy Christmas season.
But today on Money Monday, we'll tell you why you shouldn't put it off. That's next.
Holiday time probably isn't the time you're thinking about taxes, but you may probably want to start some year-end tax planning. And of course, joining us, Janet Marcantonio, to fill us all in about what we should and should not be doing. Janet?
Well, it's true. Most people don't even think about it till April. But if you take a little bit of time before the end of the year, there may be a few steps that you can take to reduce the taxes. First of all, it's been a roller coaster year in the stock market.
Really
and so
has.
if you have some investments, either in stocks or mutual funds, you may have some winners and some losers. And so taking a little bit of time to look at what you have and possibly selling your losses to offset your gains.
All right, now, is this called tax tactic one?
That's tax tactic one I put up there.
All right.
And if you can sell your losers, as I said, to offset your gains. And then in addition to that, if you have even more losses, you can sell up to $3,000 worth of losses and offset that against ordinary income on your income tax return.
That's a good idea.
So it's a great idea. And then a lot of people do that, but they don't really want to sell those stocks or mutual funds permanently, so they want to buy it back. Well, the IRS knows that little trick that people want to do, so they say that's fine, but you have to wait at least 30 days. So on the 31st day, you can buy that stock back. But a lot of people, for instance, well, let's say they had a loss in something like Merck, which is a drug stock. Instead of buying Merck back, maybe they'll buy Bristol Myers. It's the same kind of stock, and they can buy it just the very next day or at the same time they're selling Merck, so that they keep their portfolio balanced.
I see.
So that's one tactic.
All right, what about tax tactic number 2?
Well, certainly making gifts. And every year, any individual can make up to $10,000, give $10,000 to as many different individuals as they want to without paying transfer or gift taxes. So certainly, if you have a lot of assets and you want to begin reducing your estate, make gifts each year. Also, making charitable contributions. Now, obviously, making charitable contributions, you can only write that off if you itemize your deductions.
Okay. You can do that, though, at the very end of the year, decide, well, I need to do something, so write out a big fat check to a charity.
You bet, you bet. And one other very smart thing to do is maybe instead of giving cash, writing a check, is give some of that stock that's highly appreciated. Because let's say you bought stock for $100 and it's now worth $1,000. You can give that $1,000, write that off on your tax return for $1,000, but it only cost you $100 when you bought it.
Another good idea.
Yeah.
What about donate appreciated property, keep records of personal expenses?
That's right. If you're, for instance, if you do things charitable-wise, this is the end of the year, you might want to participate in like Meals on Wheels or something like that. If you're using your own personal car, you can write off that kind of expense as a charitable contribution. So keep records of that kind of thing.
All right, so some good information there. Okay, if you have a question for Janet and you'd like her to answer it, please write it to us, care of ABC 6 News at 10 Elm Street, Providence, Rhode Island, 02904. Or if you have a computer, you can email her at news@abc6.com. And we thank you very much, Janet. Back to you.
The calendar may only read December, but it's never too early to start thinking about tax time. Janet Marcantonio has some tips that could help make the days before April 15th easier in Saturday savings.
Are you one of those people who don't even think about taxes until April? If so, you may miss out on some opportunities to save. By evaluating your situation now, before year end, you may discover a few steps you can take to minimize the tax bite on April 15th. For instance, take some time to review your investment portfolio. It's been a roller coaster year in the stock market. If you own stocks or mutual funds, you could have some winners and some losers. If you realize large gains or losses, you may want to sell your losers to offset the gains. After taking the loss, you can buy back the same stock or mutual fund after 30 days without breaking any IRS rules. Or you can immediately replace the loser with a similar fund or stock so that your portfolio remains well balanced after a tax selling move. In addition to offsetting all your gains, you can offset up to $3,000 of ordinary income with investment losses. While you don't want the tax tail to wag the investment dog, tax selling may provide some savings opportunities this year. Ask your financial advisor. That's your Saturday savings tip. I'm Janet Marcantonio.
But if you can't charge because of bad credit or none at all, we have some advice coming up for you in Money Monday. Welcome back. As you plug ahead in your holiday shopping, you'll hear lots of advice on how not to overspend. But what if it's too late? And what if you already have poor credit? Well, our financial expert, Janet Marcantonio from Bank Boston Private Bank, is here now with some advice. And that's a hard thing.
It is hard. But
You know,
there is a great product out there that can be a great help.
meaning the credit card?
It's the secured credit card.
Okay.
And basically it works like any other credit card, except that you put down you make a deposit into a certificate of a deposit with a bank, and that's used as collateral for this credit card.
Okay.
And then your credit line is up to the amount of your deposit. And so that it's their way of ensuring that you're going to pay that back, and if you don't, they have the right to go in and take it out of that deposit.
So what would be the minimum amount? What do you have to put down? Maybe $1,000 or $2,000, and then it's almost like a savings account.
Well, exactly, because they pay interest on that, too. And so that's one of the things you want to look at is what kind of interest do they pay on your certificate of deposit while it's sitting there, because it's completely frozen while it's there securing the credit card. But typically around $1,000 are the average minimums. I think there are some you can find out there for $500. You know, just the place to start is with your bank, see if they have one. And then from there you can go onto the internet and find out other areas. But I think once you find a place that does a secured credit card, do good consumer shopping and shop around. So find out what are the annual fees that they charge, and what, make sure that there is a competitive rate on the deposit. Some may charge a higher annual fee, but also give a higher rate on the deposit, so you want to weigh it out.
Are these new, Janet? Because I'm not so familiar with a secured credit card.
Yeah, they've been around.
Really?
They certainly have been around, and it's just something that a lot of people don't know about, and it's great for someone who either needs to start credit.
Right. Well, it's good that you're here to tell us more about it. Now, how about the person out there who's saying, well, you know what, I went bankrupt, or I just haven't had good credit. I know I've had late car payments, late mortgage payments. Do these people, can they apply?
Absolutely, they can.
Okay.
They can. Because you don't need good credit. You've got the security right there.
They've got your money.
They've got your money.
Okay.
That they can take.
So it's not that complicated. And again, you could find these at any bank?
Not
It's not
any
something
bank.
that's coming in the mail, is it?
No, it's not something that's coming in the mail, and not every bank offers it, no.
Okay.
So start with your bank, but then begin to look around and start, like I said, a great place is on the internet. And if you don't have a computer, go to your library and search through the internet of credit card companies that have secured credit cards.
And I think a lot of college students, even just starting out, they seem to, you can't get credit if you don't have credit, that kind of a thing, but this would be a good starting point.
It's a great starting point.
All right, secured credit cards.
Secured credit
cards. Oh, no, I didn't know about that.
That's right.
Thank you, Janet Marcantonio, for joining us. If you have any questions for Janet on any of your financial concerns, you can always write to her in care of us, and she will try to answer them during this segment. Every Monday, you can address your concerns to Money Monday, care of ABC 6 TV on 10 Orm Street in Providence, and the zip 02904, or you can email Janet, and you can send it to us, news@abc6.com, and of course, we all look forward to hearing from you. Marilyn?
Always. If the spirit of the season has you in a giving mood, you may be able to benefit from your donations. Janet Marcantonio has more in this week's Saturday Savings.
Time of year for giving, and the pleasure you get from giving just may be increased by getting a tax deduction for your generosity. Here are some points to consider. Charitable contributions are fully deductible as long as you itemize your deductions and they exceed the standard deduction. Instead of cash, consider donating appreciated property, such as stock or mutual funds. You generally get a deduction for the full value of the property without having to pay capital gains tax on the appreciation. If you use your automobile or have out-of-pocket expenses in providing services for a charitable organization, you may take a tax deduction for those expenses. Contributions made directly to an individual or to groups of individuals are not normally deductible. But if you make contributions to a qualified charitable organization, you're not only helping to improve the lives of others, you'll be helping your tax return. That's your Saturday Savings Tip. I'm Janet Marcantonio. Now, before year end, you may discover a few steps you can take to minimize the tax bite on April 15th. For instance, take some time to review your investment portfolio. It's been a roller coaster year in the stock market. If you own stocks or mutual funds, you could have some winners and some losers. If you realize large gains or losses, you may want to sell your losers to offset the gains. After taking the loss, you can buy back the same stock or mutual fund after 30 days without breaking any IRS rules. Or you can immediately replace the loser with a similar fund or stock so that your portfolio remains well balanced after a tax selling move. In addition to offsetting all your gains, you can offset up to $3,000 of ordinary income with investment losses. While you don't want the tax tail to wag the investment dog, tax selling may provide some savings opportunities this year. Ask your financial advisor. That's your Saturday Savings Tip. I'm Janet Marcantonio.
If the spirit of the season has you in a giving mood, you may be able to benefit from your donations. Janet Marcantonio has more in this week's Saturday Savings.
Time of year for giving, and the pleasure you get from giving just may be increased by getting a tax deduction for your generosity. Here are some points to consider. Charitable contributions are fully deductible as long as you itemize your deductions and they exceed the standard deduction. Instead of cash, consider donating appreciated property, such as stock or mutual funds. You generally get a deduction for the full value of the property without having to pay capital gains tax on the appreciation. If you use your automobile or have out-of-pocket expenses in providing services for a charitable organization, you may take a tax deduction for those expenses. Contributions made directly to an individual or to groups of individuals are not normally deductible. But if you make contributions to a qualified charitable organization, you're not only helping to improve the lives of others, you'll be helping your tax return. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Today, another holiday shopping tradition begins, returning presents that missed the mark. But before you go out, there are some tips that could make your returns easier. Janet Marcantonio has more in this week's Saturday Savings.
The day after Christmas is an official holiday in Canada and Great Britain. It's called Boxing Day. Though it didn't originate as such, it has come to mean the day when you box up all those misfitting or ill-conceived presents and return them. Well, it's not all that different here in New England. Many of us will spend the better part of this weekend returning Christmas gifts. To save time, aggravation, and money, here are a few pointers from retailers in the U.S. Post Office. First, receipts are king. If you have the receipt for an item, it not only speeds up the process, but you're guaranteed to get the full value back. With no receipt, many stores will refund only the lowest price the item sold for in the last 30 days. If you're returning a package by mail, ask the price difference between parcel post and priority mail. Depending on the destination zip code, the difference could be as little as 5 cents. Parcel post can take up to 2 weeks, while priority mail is 2 to 3 days. If you're waiting for a refund or credit, you'll have it that much sooner. Finally, both retailers and the post office say you'll be in and out a lot faster if you make your returns early in the morning or late in the day. That's your Saturday Savings Tip. I'm Janet Marcantonio.
New Year's means New Year's resolutions. If one of those is to reduce your credit card debt, then Janet Marcantonio has advice for you in this week's Saturday Savings.
At the start of the new year, perhaps your first New Year's resolution will be to pay off the credit card debt you built over the holidays. If so, here are a few pointers. First, consider consolidating your debt onto one credit card with the lowest interest rate. Now, credit unions often have some of the lowest rates around. Or you can go online to the Bank Rate Monitor website to find the best card rates from banks across the country. If you don't have a computer, use one at your local library. Some credit cards offer a low introductory rate. It may be a good deal, but make sure it doesn't balloon to a much higher rate after the introductory period. Once you've consolidated your debt onto one card, destroy your other credit cards, or at least put them away until you have this debt paid off. If you can't consolidate, pay the minimum due on your low-interest debt and pay off as much as you can on the high-interest cards like department store cards. Continue paying the same amount even when the balance and minimum payments go down. After all, your goal is to start the next holiday season free of the shackles of debt. That's your Saturday Savings Tip. I'm Janet Marcantonio.
If the new year means a better financial plan, then Janet Marcantonio has advice to get 1999 started the right way this week's Saturday Savings.
Every year, do you resolve to improve your financial picture, to reduce your debt and turn those savings into investments? Yet a new year begins and you find yourself right back where you started, or worse, further behind? Then let 1999 be the year that you take control. Each week here on Saturday Savings, I'll share ideas with you that will put dollars back in your pocket and set you on the path to financial stability. The first step is to get organized. If you don't have a handle on your current condition, you can't expect to improve it. Make a list of everything you own and add up the total value. That's known as your assets. Keep a file for every category, including real estate, personal property, investments, retirement plans, and insurance. Then, list and subtract your total outstanding debt. That's known as your liabilities. The result is your net worth. This will be your benchmark to try and improve on. As you begin to apply our tips for reducing expenses and turning those savings into investments, you can make your net worth grow. And by the year 2000, maybe you'll finally be ahead of the game. I'm Janet Marcantonio.
If the new year means a better financial plan, then Janet Marcantonio has advice to get 1999 started the right way this week's Saturday Savings.
Every year, do you resolve to improve your financial picture, to reduce your debt and turn those savings into investments? Yet a new year begins and you find yourself right back where you started, or worse, further behind? Then let 1999 be the year that you take control. Each week here on Saturday Savings, I'll share ideas with you that will put dollars back in your pocket and set you on the path to financial stability. The first step is to get organized. If you don't have a handle on your current condition, you can't expect to improve it. Make a list of everything you own and add up the total value. That's known as your assets. Keep a file for every category, including real estate, personal property, investments, retirement plans, and insurance. Then, list and subtract your total outstanding debt. That's known as your liabilities. The result is your net worth. This will be your benchmark to try and improve on. As you begin to apply our tips for reducing expenses and turning those savings into investments, you can make your net worth grow. And by the year 2000, maybe you'll finally be ahead of the game. I'm Janet Marcantonio.
If you're dealing with education loans, there may be a way to ease your monthly burden. Janet Marcantonio has that advice in this week's Saturday Savings.
If you have education loans eating away at your pocketbook, time is running out on an opportunity to ease that bite. Until January 31st of this year, 1999, you can refinance your loan at a lower interest rate. Under normal circumstances, you've been able to consolidate your education loans, student and or parent loans, to get a single monthly payment and even lower your payments by stretching out the number of years over which you pay the loan. The interest rate has generally been 8.25%. Right now, you can get the bonus of a lower interest rate as well. The structure of the interest rate savings varies. The federal government's direct loan consolidation program gives you a low initial rate of 7.46%. The private lender, Sallie Mae, offers one discount for having automatic payments from your bank account and then another after you've made 48 repayments on time. Check both options to see which makes the most sense for you. For information on the federal government's direct loan, call 1-800-557-7392 or go on the World Wide Web at ed.gov/direct loan. And for Sallie Mae's Smart Loan, call 1-800-524-9100 or check www.salliemae.com. But hurry! Congress has set a time limit on this as of January 31st.
If you're looking to make your gas money go farther, Janet Marcantonio has some advice and Saturday savings that could stretch out the miles per gallon.
If you can think of a better way to spend your money than at a gas pump, here are some ways to drive down the cost of fueling your car. As with any purchase, price shop. While all brands of gasoline are not identical, they're close enough. Compare brand name stations to independents. You'll find prices can vary by a dime or more a gallon. And don't overpay for premium. The American Automobile Association says that less than 10% of cars on the road today need it, yet about 20% of drivers buy it and pay an average of 16 cents a gallon more. Check your owner's manual for the lowest grade it recommends. Also, use self-service. You'll save an average of 25 cents a gallon by pumping it yourself. For a 15-gallon tank filled once a week, that's $200 in savings a year. Finally, inflate your tires properly. Underinflation causes them to wear out too soon and lowers gas mileage. You can inflate your tires 2 to 4 pounds above the recommendation in the owner's manual, but don't exceed the maximum pressure indicated on the side of the tire. That's your Saturday savings tip. I'm Janet Marcantonio.
If you're one of the thousands of Americans planning a move this year, there are many ways to keep the costs down. But you have to know what to look for. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
We're a nation on the move. Almost 1 in 6 Americans can expect to relocate this year. And according to the American Movers Conference, the average bill will be almost $3,000. If you're footing the bill, here are some ways to keep down the costs. Shop around for your mover. Ask neighbors, real estate agents, and your company's facilities manager for recommendations. Get at least 3 written estimates, and make sure they're binding estimates. Some movers offer a non-binding estimate based on the weight of your belongings once it's in the truck. That can be a lot more risky. If you have some flexibility, move in the off-season. Movers are the busiest and the most pricey during the summer months. According to Consumer Reports, if you move after September 30th and before June 1st, you can save about 10%. Supply your own supplies and pack it yourself. You can usually get free boxes from liquor stores and supermarkets. If you have to buy boxes, check the rates at move-it-yourself movers, such as U-Haul, before buying from your mover. And finally, if your move is job-related, see if you're eligible for a tax break. Now, the rules are complicated, so ask your tax advisor or get IRS publication 521 titled Moving Expenses. That's your Saturday Savings tip. I'm Janet Marcantonio.
Then you can expect to receive a big tax credit this year. But there are certain requirements you must fulfill. Financial planner Janet Marcantonio has the details in this week's Saturday Savings.
If you're preparing to file your federal tax return and you have children under the age of 17, then get ready to claim a big tax credit for each of them. If you meet a few basic requirements, you'll be able to cut your tax bill by $400 for each child you claim. The basic rules are these. Each child you claim must have been under the age of 17 as of December 31st, 1998. You must be able to claim the child as a dependent on your federal income tax return. The child must be a U.S. citizen or resident alien. Now, there are income limits, but most people will be able to meet them. If you're married, filing a joint return, you'll be able to claim the full credit if your adjusted gross income is less than $110,000. If you file single, head of household, or qualifying widow or widower, you'll get the full credit with an adjusted gross income of less than $75,000. If your income is above these limits, then you may get a partial credit. To get the credit, you have to fill out the child tax credit worksheet that's included in the income tax package you received from the IRS. It's a little complicated, but can be well worth the effort. That's your Saturday Savings Tip. I'm Janet Marcantonio.
When using an ATM machine, there are some important things to keep in mind to make sure you're not paying more than you should for electronic service. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
The automatic teller machine is the ultimate symbol of convenience. It gives us the freedom to bank whenever and wherever we go. But you can pay a price for that convenience, so keep these points in mind when you head for the nearest cash dispenser. Depending on the type of account you have with your bank, you may be limited to the number of free ATM transactions per month. Even if your bank account allows for unlimited free ATM transactions, it's usually restricted to ATM machines owned by your bank. So if you bank at Fleet but use a Bank Boston ATM machine, you can expect to be charged a fee by both banks. The average surcharge for using an ATM outside your bank's network is $1.50 per transaction. A transaction includes deposits, withdrawals, transfers, and balance inquiries. So when you use another bank's ATM, those fees could add up. Many banks offer touch-tone telephone banking where there are no charges for transactions. Consider using telephone banking for your balance inquiries and transfers and limit using the ATM for your deposits and withdrawals. That's your Saturday Savings Tip. I'm Janet Marcantonio.
If you're one of the thousands of Americans planning a move this year, there are many ways to keep the costs down. But you have to know what to look for. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
On the move. Almost 1 in 6 Americans can expect to relocate this year. And according to the American Movers Conference, the average bill will be almost $3,000. If you're footing the bill, here are some ways to keep down the costs. Shop around for your mover. Ask neighbors, real estate agents, and your company's facilities manager for recommendations. Get at least 3 written estimates, and make sure they're binding estimates. Some movers offer a non-binding estimate based on the weight of your belongings once it's in the truck. That can be a lot more risky. If you have some flexibility, move in the off-season. Movers are the busiest and the most pricey during the summer months. According to Consumer Reports, if you move after September 30th and before June 1st, you can save about 10%. Supply your own supplies and pack it yourself. You can usually get free boxes from liquor stores and supermarkets. If you have to buy boxes, check the rates at move-it-yourself movers, such as U-Haul, before buying from your mover. And finally, if your move is job-related, see if you're eligible for a tax break. Now, the rules are complicated, so ask your tax advisor or get IRS Publication 521, titled Moving Expenses. That's your Saturday Savings Tip. I'm Janet Marcantonio.
So move now and wait till the fall. Well, if insomnia keeps you up all night, there are many ways to help break this April. Financial planner Janet Marcantonio has the details in this week's Saturday Savings.
While inflation chugs along at less than 2%, the cost of college education expenses has steadily risen at an average of 8% per year. Congress took some steps to ease the burden on the average family's pocketbook by way of the Taxpayer Relief Act of 1997. If you're getting ready to file your 1998 tax return and you have kids in college, you may be able to claim for the first time one or both of 2 education tax credits. The new Hope Scholarship credit may be claimed if you incurred expenses for qualified tuition and related costs during a student's first 2 years of college. The tax credit is a maximum of $1,500 per student. There is also the Lifetime Learning Credit, which can be a maximum of $1,000 per household for any tax year. The Lifetime Learning Credit is not limited to a student's freshman and sophomore years in college and is more flexible in its qualification requirements. There are adjusted gross income limitations for both the Hope Scholarship and the Lifetime Learning Credits, so check with your tax advisor or get IRS Form 8863 by calling 1-800-TAX-FORM to figure out if you qualify. That's your Saturday savings tip. I'm Janet Marcantonio.
But if you're in the market for homeowners insurance, do you know what to look for and how much to invest? Financial planner Janet Marcantonio has details in this week's Saturday Savings.
History credits Ben Franklin with founding the first fire insurance company in America. And though it's not as exciting as flying a kite in a lightning storm, property insurance has proven pretty useful over the past couple of centuries. But how can you keep the roof on the cost of today's homeowners insurance? Well, first, shop around. Prices can vary from company to company, so try to get at least 3 quotes. And raise your deductible. The Insurance Information Institute says raising a $250 deductible to $500 will typically save you up to 12% on your premium. And don't overinsure your home. Don't determine your coverage by how much you pay for your home or how much it would sell for. For one thing, you don't have to replace the land if the house burns down, so don't include its value in the replacement cost. And finally, ask for the discounts. Many insurers typically will give discounts for having smoke detectors or burglar alarms, for new homes, for non-smokers, and for homeowners age 55 and retired. These are just a few of the ways you can take home the savings when insuring your home. That's your Saturday Savings tip. I'm Janet Marcantonio.
Well, remember, don't shoot the messenger. This is just a reminder. You have 26 days to complete your taxes. If you haven't started, financial planner Janet Marcantonio has some overlooked deductions in Saturday Savings that could lower your tax bill.
High taxes are bad enough, but paying more than you have to is even worse. There are some tax deductions that are frequently overlooked. If you haven't yet filed your tax returns, consider these. It's a common practice to reinvest mutual fund or stock dividends instead of collecting them in cash. You pay taxes on those dividends in the year they're received. If you go to sell your mutual fund or stock in a subsequent year, you want to be sure to add those dividends to the cost of the stock when figuring your gain or loss. If you don't, you'll be paying tax twice on those dividends. To make sure you take credit for all reinvested dividends, go back to your prior tax returns. And remember to keep all year-end mutual fund statements. While you have last year's tax return out, look for loss carryovers. Now, these are losses incurred in prior years, which you couldn't fully deduct in those years due to IRS limitations. But they're not permanently lost and can be used in future years. These losses can be used first against any gains, then you can deduct up to $3,000 from ordinary income. Everyone wants tax deductions, so make sure you and your tax preparer don't miss these nuggets. That's your Saturday Savings tip. I'm Janet Marcantonio.
Saturday Savings.
You've probably had the call, the telemarketer from one of the big phone companies offering you their discount plan. Well, whether it's because we're bothered by their tactics or afraid of signing up with a bad plan, or just because we're not comfortable and don't see any reason for change, long-distance companies say more than 2/3 of us are paying full price for calls when we don't have to. AT&T says anyone who makes long-distance calls should be on a calling plan, yet 60% of their customers pay basic rates. So how do you find the best plan for you? Well, conduct a checkup. First, determine your calling patterns. Take a look at your long-distance bills for the past 3 months. Determine when you make the greatest number of calls, what time of day, and the average length of your calls. Also, see if you frequently make calls to the same number or area code. Then, shop around. Start by calling your current provider. Ask them if you're on their least expensive plan, given your usage. Then call at least 2 other providers. Now be alert. Many new long-distance companies promote low rates, but require a monthly access charge, monthly minimums, or a minimum duration per call. The plans are constantly changing. The higher your phone bill, the more often you should conduct a checkup. But make an attempt at least once a year. That's your Saturday Savings tip. I'm Janet Marcantonio.
Financial planner Janet Marcantonio has some important credits in Saturday Savings that could save you money.
If you're one of the thousands of Americans who wait until the last minute to prepare and file your tax returns, your minute is near. If you haven't yet looked at your return, you may be surprised to find a number of new tax credits that will require special computations or separate forms. According to the IRS, the #1 error in 1998 tax returns filed so far is not taking advantage of the child tax credit. Now, that's where you can get up to $400 off your tax bill for each child you have that was under the age of 17 on December 31st, 1998. But you have to perform the calculation that's in your 1040 instruction booklet and then fill in the result on your return. If you have more than 2 children that qualify for this credit, you'll need a separate form that's not provided in the package that was sent to you. You'll also need a separate form for claiming the education credits and if you did a Roth IRA conversion. The forms are available by calling 1-800-TAX-FORM, but that does take 10 business days for delivery. If you've waited this long, now the best place to get any forms you need is through the Internet at www.irs.ustreas.gov. You can get access to the Internet at any library. You can also get forms as well as help with completing your return at local IRS offices. In Rhode Island, there's one located at 380 Westminster Street in Providence and at 60 Quaker Lane in Warwick. Their hours are Monday through Friday, 8 a.m. to 4:30 p.m., and in the Providence office on Saturday from 8 a.m. to 12:30 p.m.
This week's Saturday Savings.
According to the U.S. Council for Energy Awareness, the average family spends between $2,000 and $4,000 each year on energy for their home. By applying some simple energy guidelines and appliance use tips, you could save some serious money. Here's a few examples. Your refrigerator requires more energy than any other household appliance. In the U.S., refrigerators use 7% of the nation's total electricity. Make sure your refrigerator is set between 38 and 42 degrees Fahrenheit and the freezer between 0 and 5 degrees. Check to see if the door is tightly sealed by closing it on a piece of paper and then trying to pull the paper out. If it slides out easily, it's a sure sign that cold air is escaping. Keep the refrigerator coils clean. Brush or vacuum them at least twice a year. And keep your refrigerator full because food retains cold better than air. The average home washing machine accounts for as much as 25% of the electricity used in American homes. Save energy by setting the water level to suit the size of the load, experimenting with cold water wash and rinse cycles, and washing on a delicate cycle instead of regular. A dishwasher requires 37% less water than washing dishes by hand with water running. Wash only full loads, use short cycles, and air dry the dishes by turning off the dishwasher after its final rinse and opening the door for the dishes to dry. Remember, saving energy means saving money. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Right, those darn computers, they have a mind of their own. Well, if you're looking to donate to charity, but you want to make sure your contributions are going to the right place, there are some easy steps you can take. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
Each year, Americans give more than $150 billion to charity, according to the American Institute of Philanthropy. So how do you make your donations count? Well, here's some advice from the AIP. Never give to a charity you know nothing about. Decide on your own which causes you want to support, then get a list of groups that support these causes from your local library. Each year, the IRS publishes a list of approved charities. If your charity doesn't appear on the list, your contributions will not be tax deductible. Find out where your dollars go. In general, at least 60% of your donations should go towards the charity's programs. Ask how much the charity pays its top executives, if the fundraising is done by volunteers or by paid solicitors, and how much money the charity already has. Ask about recent accomplishments. What has the group done to further your cause? Be wary of hard luck stories and pressure to donate on the spot. Give by check rather than cash, and never give your credit card number to a phone solicitor. Decide what you can afford to give and stick to your budget. Tell your favorite charities that you'll respond once or twice a year to their solicitations, but no more. Support organizations that respect your wishes. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Those darn computers, they have a mind of their own. Well, if you're looking to donate to charity, but you want to make sure your contributions are going to the right place, there are some easy steps you can take. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
Each year, Americans give more than $150 billion to charity, according to the American Institute of Philanthropy. So how do you make your donations count? Well, here's some advice from the AIP. Never give to a charity you know nothing about. Decide on your own which causes you want to support, then get a list of groups that support these causes from your local library. Each year, the IRS publishes a list of approved charities. If your charity doesn't appear on the list, your contributions will not be tax deductible. Find out where your dollars go. In general, at least 60% of your donations should go towards the charity's programs. Ask how much the charity pays its top executives, if the fundraising is done by volunteers or by paid solicitors, and how much money the charity already has. Ask about recent accomplishments. What has the group done to further your cause? Be wary of hard luck stories and pressure to donate on the spot. Give by check rather than cash, and never give your credit card number to a phone solicitor. Decide what you can afford to give and stick to your budget. Tell your favorite charities that you'll respond once or twice a year to their solicitations, but no more. Support organizations that respect your wishes. That's your Saturday savings tip. I'm
Steve Winwood. I'm good. It's kind of like Casey and the Sunshine Band. We got to get down tonight because of the great weather. We're pushing it now. If you're planning on a new addition to the family, it's important to face the financial future and the questions of a new child. How can you balance your budget with a newborn? Financial planner Janet Marcantonio has details in this week's Saturday Savings.
The race is on for the first baby of the new millennium. Of course, the cost of raising the child from cradle through college could cost as much as $1.45 million. So paring down the cost of raising a baby to a manageable slice of your household budget requires both pre- and postnatal attention to financial details. Long before the stork arrives, check your employer's parental leave policy to determine whether the leave comes without pay. Then adjust your budget accordingly. Purchase life insurance on both parents. Even though a stay-at-home parent isn't bringing home an income, his or her death and the resulting need for child care could unbalance the family budget. After the baby is born, be sure to get a Social Security number for your newborn. You may now look forward to a tax deduction for your bundle of joy, as well as the new $400 tax credit. Don't forget to add your newborn to your health care plan as soon as possible. To help save for college expenses, look into the new Rhode Island Higher Education Trust, or consider using your own tax-deductible retirement vehicle, such as an IRA or 401k. The new tax law allows penalty-free withdrawals from IRAs for education expenses, and you can borrow from your 401k. Attending to a few important financial details will provide you with the peace of mind that comes from knowing your financial house is in order and ready for a new member of the family. That's your Saturday Savings Tip. I'm Janet Marcantonio.
And that's not all.
A local company announces it's going to split its stock. Is now the time to buy? But what does it really mean? We'll explain this week on Saturday Savings.
So,
Brought to you by OSO.com.
for you, and what effect can it have on your investments? Financial planner Janet Marcantonio explains the numbers in this week's Saturday Savings.
Many individual stock market investors are captivated when they hear that a company's stock is going to split. Some think it's a ticket to instant wealth. But what effect does a stock split have, and what does it mean for the average investor? In a stock split, a company exchanges one share for a larger number of shares without raising the overall market value of its stock. For example, a share worth $100 might be exchanged for two shares worth $50 each. Thus, the total dollar value of an investor's holdings doesn't change. So why does a company want to split its stock? Companies advertise splits as a way to make expensive stocks more affordable for investors. Frequently, a stock split causes the stock's price to zoom higher immediately after it's announced. But stock splits don't always work out to the investor's long-term advantage. Remember, a stock split is just a bookkeeping development. It has no bearing on how that company is likely to do over the medium or long term. In fact, some may suggest that the stock price has gone as high as it's going to go. So when you are looking to purchase a stock, evaluate it on fundamental factors, such as the earning prospect of the company, not on whether the stock is going to split. That's your Saturday Savings Tip. I'm Janet Marcantonio.
So splitting, so get out and enjoy today. If you found yourself overstretched by debt, there are still ways to protect your credit standing in troubled times. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
With lenders making it more convenient and easier than ever to borrow, many people have found themselves over their heads in debt. If you find that your debts are out of hand, don't ignore them. The sooner you deal with your credit problems by discussing them with your lenders, the more lenient and the less painful your exit from debt will be. There are three basic rules when dealing with creditors. Be honest, be humble, and be in touch. Creditors are eager to work with people who admit they're in trouble and need some help working things out. You'll find it easier to gain extensions by approaching the creditor first. So whether you've lost your job, overspent, whatever the reason, the moment you become aware you'll have difficulty meeting your obligations, develop a plan to contact those creditors who will be affected and tell them the situation. Your first contact should be by phone, since most have 800 numbers, followed by a letter confirming your phone conversation. In addition to getting your financial situation in balance, your other goal is to keep your credit record as clean as possible during this temporary indebtedness. Your cooperation with credit agencies will make a difference in what, if anything, they report to credit reporting firms. For more information and help, contact the National Center for Financial Education on the web at www.ncfe.org. That's your Saturday Savings Tip. I'm Janet Marcantonio.
I'm here.
Okay. If a financial setback required you to raise money quickly, would you know the best way to create capital? Financial planner Janet Marcantonio lets you know the safest plan in this week's Saturday Savings.
If you needed to put your hands on $10,000 to meet an unexpected expense, which would be the cheapest way to obtain it? Would it be to charge it to a credit card, sell your stock, borrow from a 401k plan, or take out a home equity loan? If you answered take out a home equity loan, you'd be correct. According to a national survey, 77% of homeowners describe their ability to manage money as excellent or good, but only 9% would choose a home equity loan to borrow money. Charging $10,000 for 1 year to a credit card would be the worst choice, costing upwards of $1,800 in interest. Selling your stock could cost $1,000 or more in capital gains and would interrupt the growth opportunity you have in owning the stock. Borrowing from a 401k would cost $875 in repayment interest, and if something happens and you have to leave the company, you have to pay back the loan immediately or pay income taxes on the balance, plus you'd have to pay a 10% penalty. A home equity loan would cost only $558. That's because it has the lowest interest rate and the interest is tax deductible. So if you need funds for a major capital expenditure, such as a home renovation, school tuition, or medical bills, consider a home equity loan. But don't tap the credit for a vacation or spin of the roulette wheel at Foxwoods. After all, your home is on the line. That's your Saturday Savings Tip. I'm Janet Marcantonio.
If you're looking to make more money, then you may consider investing in the stock market. But there are a few things you need to know before you get in. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
With the stock market hitting all-time highs, some people wonder whether it's too late to get in, while others wonder if they should get out. Forget trying to figure out the market's highs and lows. If you're investing for a long-term goal of 5 years or more, such as retirement or college education, then you probably should have some money in the stock market. Historically, the stock market has outperformed other investments. Buying and holding stocks for 5 years or more can position you to make a healthy return. So how do you know what stocks to pick? If you're a beginning investor, you may want to consider staying away from individual stocks, at least initially. Instead, choose a stock mutual fund that's compatible with your investment goals and tolerance for risk. A mutual fund reduces your risk because it diversifies your investment in a basket of stocks, and it provides professional management of your funds, saving you time and worry. If you have a complete financial plan and are ready to invest in some individual stocks, be sure to do your homework before you buy. Target a growing industry that you understand. Then pick a company with potential. Read company information, such as the annual report, and pay attention to security analysts' recommendations. If you're just starting to pick individual stocks, general wisdom dictates not to invest any more than you can afford to lose. After all, what goes up can come down. That's your Saturday Savings Tip. I'm Janet Marcantonio.
It's a little planning to switch jobs. There are some important facts about your 401k plan you need to know before you move. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
According to a recent national survey, nearly 1/3 of all adults in the full-time job market reported a recent or imminent change in their employment. The survey showed that job hoppers tend to ignore their 401k. In fact, 24% were not aware of their options for their 401k plan when they left the company. Those options include maintaining it in the previous employer's plan, transferring it to a new employer's plan, rolling it over to an IRA rollover, or taking a cash distribution. 1 in 5 job changers chose a cash distribution of the savings plan, which is usually the worst choice. A cash distribution is fully taxable, and if you're under age 55, a 10% penalty applies. Plus, the plan is required to withhold 20% at the time of distribution. Maintaining your 401k in the previous employer's plan or an IRA rollover can continue the deference of all taxes. But be sure the former 401k trustee makes the check directly payable to the new plan's custodian, not to you. Otherwise, they will still be obligated to hold back the 20%.
Just because you rent instead of own a home doesn't mean your belongings are less valuable or treasured. So why is it that so many renters don't have insurance, and what do you need to do in order to get covered? Financial planner Janet Marcantonio has details in this week's Saturday Savings.
When more than 95% of homeowners have insurance, why do the majority of renters take the risk to live without it? Well, many renters are under the misguided notion that they're covered by their landlord's insurance in the case of a disaster such as a fire. In reality, the landlord's insurance will cover the loss of the renter's personal belongings only if the landlord is at fault, and only if you can prove it. Most renters' insurance policies will cover your personal belongings when something bad happens, no matter whose fault it is. Typically, they also cover burglaries and theft outside your home, as well as damage from smoke, lightning, windstorms, or vandalism. So if you rent, it's wise to have an insurance policy. The first thing you want to do is take inventory of your belongings to help determine how much coverage you'll need. Then contact insurance agents and get at least 3 estimates. Compare the policies for theft limits because they do vary widely. Also see whether the coverage is for the current value or the replacement value. Compare what the cost will be with different deductibles. Ask about discounts for apartments with security systems or smoke detectors. Finally, be prepared to purchase more insurance than you need because most companies have a minimum value you must set for your possessions. That's your Saturday Savings tip. I'm Janet Marcantonio.
For a homeowner, one of the most important investments you can make could be insurance. But if you're in the market for homeowners insurance, do you know what to look for and how much to invest? Financial planner Janet Marcantonio has details in this week's Saturday Savings.
History credits Ben Franklin with founding the first fire insurance company in America. And though it's not as exciting as flying a kite in a lightning storm, property insurance has proven pretty useful over the past couple of centuries. But how can you keep the roof on the cost of today's homeowners insurance? Well, first, shop around. Prices can vary from company to company, so try to get at least 3 quotes. And raise your deductibles. The Insurance Information Institute says raising a $250 deductible to $500 will typically save you up to 12% on your premium. And don't overinsure your home. Don't determine your coverage by how much you pay for your home or how much it would sell for. For one thing, you don't have to replace the land if the house burns down, so don't include its value in the replacement cost. And finally, ask for the discounts. Many insurers typically will give discounts for having smoke detectors or burglar alarms, for new homes, for non-smokers, and for homeowners age 55 and retired. These are just a few of the ways you can take home the savings when insuring your home. That's your Saturday Savings tip. I'm Janet Marcantonio. A great time and money saver is the debit card. But are there risks? I'll talk about it this week on Saturday Savings.
Financial planner Janet Marcantonio has details in this week's Saturday Savings.
The allure of leaving cash at home and going plastic has grown so quickly that by the year 2000, it's expected that 2/3 of Americans will carry debit cards in addition to their credit cards. A debit card is nothing more than a plastic check. Instead of writing a check, you use a card that deducts your purchase directly from your checking account. There are 2 ways a debit card is used. One is handled like an ATM transaction. You put in your card or swipe it through a machine, then enter your private identification number. If the money is available in your account, it's immediately deducted. That's called an online transaction. The offline transaction is where you give your card to a merchant and it's processed just like a credit card. The Visa or MasterCard logo found on most debit cards make them more widely accepted than checks. So clearly there are benefits to debit cards. They're faster than checks because you don't have to show ID. They're safer than carrying cash, and like a credit card, your liability is limited to a maximum of $50 if you report a missing card within 2 days. And you're not building debt as with a credit card. But that's also the word of caution, that it's not a credit card. So whether you use a check or debit card, the money is coming directly out of your checking account. Remember that. Then you can feel comfortable choosing paper or plastic. That's your Saturday Savings tip. I'm Janet Marcantonio.
But before you sign your child up, there are certain precautions you should take. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
If you've got high schoolers in the house, watch your mailbox this summer. Credit card companies may be trying to tempt them into starting a credit card account. It's a way for these card issuers to get a jump on all the offers students receive in college. Consumer action agencies report that most teens just can't handle credit. More and more young people are getting into debt at an early age with disastrous results. So if your teen pesters you for plastic, here are some ways to avoid disaster. First of all, educate. Use your own credit card billing as a teaching tool. Tell them that interest may start piling up as soon as a purchase is made. Only 30% of college kids know this basic fact. And don't co-sign on a new card for your child. Instead, add a second card to your own account. Get the bill sent to you and agree on a payment plan. Then talk to your card issuer about setting the credit limit for your child's card much lower than on your primary card. If you must unleash your child by co-signing, look into a secured card backed by the child's own bank account. Finally, consider a Visa or MasterCard debit card as an alternative. They're accepted most places, but instead of building credit, they deduct money directly from a checking account. When the account is empty, the party's over. That's your Saturday Savings Tip. I'm Janet Marcantonio.
An overseas trip, there are some important things that you should know about the rate of exchange. Janet Marcantonio has some tips that will save you money when traveling abroad.
If you plan to travel abroad and use traveler's checks or exchange your U.S. currency as you go, you are most likely going to play a losing hand in the foreign exchange game. By using plastic instead of cash, you can cut your travel expenses by as much as 10%. That's because all currency conversions are not created equal. The international currency exchange rate you read in the newspaper is not what you can expect to get in a shop if you exchange cash or traveler's checks. Think of the published rates as a wholesale figure. In a shop, you're buying money at retail. But if you charge your purchases, you'll usually get the wholesale or interbank rate, minus a small transaction fee. For cash from ATMs, use debit cards instead of credit cards. Credit card issuers may charge a higher transaction fee, and you're building up debt. The only thing worse than making lots of small cash exchanges abroad is changing lots of money into foreign currency at home before you travel. The exchange rate is likely to be even worse, and you'll have the security problem of walking around with a great deal of foreign currency in your pocket. A better bet is to travel with little or no currency. Then make smart exchanges once you get to your destination. When you land at an international airport, look for an airport ATM where you can make enough of a withdrawal to cover your expenses until you can find a bank ATM in town where the rate will be even better. So when going foreign, go plastic. That's your Saturday Savings Tip. I'm Janet Marcantonio.
What a week. Buying a home is a tremendous investment, and when it's time to sell, how can you make sure your investment will pay off? Financial planner Janet Marcantonio has details in this week's Saturday Savings.
According to the U.S. government, the number of people who own houses has risen to a record level. Over 66% of Americans now own homes, and the buying boom continues to soar. It's a seller's market. But if you're planning to sell your home, be prepared. Here's how. First, find a good agent. You want an aggressive one who has made plenty of sales in your marketplace. Get recommendations from people who've recently sold homes. Also, avoid long listing contracts. That way, if your home hasn't sold in a few months, you'll be able to change agents. Remember, if you don't use an agent, you may save money, but you probably won't get wide exposure or top dollar for your home. Next, price your home to the market. Don't expect people to pay what you feel the home is worth. A professional appraisal may alleviate pricing problems. Also, make the inside and outside look appealing. If your home doesn't look good curbside, many buyers will move on to the next listing. Finally, fix any known problems. Potential buyers will take the repair price into account when making a bid. Remember, don't breeze into the sales process. Take the right steps and get the most you can from your home. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Pull them out to see if they're still earning interest. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
President Franklin D. Roosevelt placed the first order for a U.S. savings bond in a radio broadcast in April of 1941. Since then, bonds have continued to be a very popular savings vehicle. Today, approximately 55 million people own savings bonds. If you're one of them, the odds are very good that you don't know the current value of the bonds you hold. That's because because we tend to view U.S. savings bonds as a buy and hold investment that we squirrel away and rarely look at. But it's important to periodically check your bonds to make sure that they're still earning interest. Savings bonds earn interest for different lengths of time, depending on the series of the bond and in some cases when the bond was issued. In general, most bonds earn interest for 30 years from the date of issue. The exception is Series E bonds, issued up to November of 1965, which earn interest for 40 years. Check the issue date on the upper right-hand corner of each bond. If your bonds have stopped earning interest, you should cash them in or exchange them. Tax on all the interest earned becomes reportable on your tax return in the year the bonds reach final maturity, even if you don't cash them in. If you have matured Series EE or E bonds, you can continue to defer reporting the accrued interest for another 20 years by converting them to Series HH bonds. But you have to make the exchange within 1 year after the original Series E bond has matured. So, get out your bonds and check your maturity dates. That's your Saturday savings tip. I'm Janet Marcantonio.
This may help. Financial planner Janet Marcantonio has details in this week's Saturday Savings.
According to some public opinion polls, the greatest area of financial concern for most American families is paying for a child's education. Many states, including Rhode Island and Massachusetts, have created savings programs designed to help meet this daunting challenge. Now, not to be confused with the more common prepaid tuition plans, where you pay today to lock in the tuition of a state university your child will attend later, the new savings plans are vastly different and much more flexible. The Rhode Island Higher Education Savings Trust, or RIHEST, is a great example. Anyone can open an account. They don't even have to be a Rhode Island resident. There's a minimum initial contribution of $500, but that can be waived if you set up an automatic investment plan where you invest at least $50 per month. The funds are managed by highly rated investment management firms in a combination of stocks and bonds that correspond to the age of your child. The earnings on the investment aren't taxed until they're withdrawn to pay college expenses, and then they're taxed at the student's tax rate. The invested funds can be used for educational expenses at any accredited college in the country, and unused funds may be transferred to other related beneficiaries. For more information about RIHEST and other states' college savings plans, visit their websites through www.collegesavings.org. That's your Saturday savings tip. I'm Janet Marcantonio.
Popular, but how do they work? Our financial planner Janet Marcantonio explains in this week's Saturday Savings.
Internet auctions are the latest rage. At last count, the number of auction websites had grown to over 300, with sales topping $2 billion. So with online auctions being so hot, how do you keep from getting burned? First, here's how they work. eBay, for example, the most popular of them all, has over 1 million items up for auction at any given time, but they don't hold any of it in inventory. The company simply provides a stage, which is the website, for customers to do business directly with each other. eBay collects a fee for listing the item and takes a cut of the sales price. During the set listing period, anyone can submit a bid. At the close of the auction, the highest bid wins. To buy or sell an item, all you have to do to get started is log on and register. One hint for if you want to sell an item: be sure to put in a reserve the price minimum dollar amount you'll accept. And if you're a buyer, don't overpay. Most auctions last 3 days to a week. Use that time to check sales prices on other auction sites, local retailers, or used goods stores. Also, find out if you can return the item if you don't like what you get. Find out who pays the shipping, which can be costly on big items. And avoid bidding wars. You may want to wait until the auction is nearly over, then submit the best price you're willing to pay. For your protection, some sites, such as eBay and Auction Universe, offer fraud insurance to buyers. If possible, use a credit card, which provides chargeback protection. That's your Saturday savings tip. I'm Janet Marcantonio.
College students. And as always, we'll have all the weather you'll need.
And it's the last weekend for the SunSmart's UV Index. We'll let you know if it'll be a sunny holiday weekend. Plus,
I'm Janet Marcantonio. The average American spends 18 years in retirement. Are you financially ready? Well, this week on Saturday Savings, I'll give you some tips to prepare.
Forward to, but will you be able to relax and enjoy yourself when you reach that golden age? Financial planner Janet Marcantonio has tips to make sure your retirement will be a time to shine in this week's Saturday Savings.
Financial security doesn't just happen. It takes planning and commitment. And yes, money. But the fact is, less than half of Americans have put aside money specifically for retirement. And the average American can expect to spend 18 years in retirement. So here are some tips from the American Savings Education Council to beat the clock and prepare for retirement. Know your retirement needs. Experts estimate that you'll need 70 to 90% of your pre-retirement income to maintain your standard of living when you stop working. Find out about your Social Security benefits. Social Security pays the average retiree about 40% of pre-retirement earnings. Call the Social Security Administration for a free personal earning and benefit estimate statement. And if your employer offers a pension or profit-sharing plan, check to see what your benefit is worth. Most employers will provide an individual benefit statement if you request one. And before you change jobs, find out what will happen to your pension. Learn what benefits you may have from previous employment. And find out if you'll be entitled to benefit from your spouse's plan. Contact the U.S. Department of Labor for a free booklet on private pensions. And if your employer offers a tax-sheltered savings plan, such as a 401k, sign up and contribute all you can. And put money into an individual retirement account or IRA. And finally, don't dip into your retirement savings. If you change jobs, roll over your savings directly into an IRA or your new employer's retirement plan. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Full swing, you may be feeling a financial pinch. How can you keep your budget under wraps? Janet Marcantonio has tips now in this week's Saturday Savings.
Managing the family budget is a full-time job that can become more complicated as the family prepares for the holidays. Even the best budget can be challenged at this time of year. Smart shoppers write the holiday gift season into each month's budget and buy presents here and there all year long. But if you're like most of us, it's coming down to the wire and you didn't plan ahead. So here are a few tips to get on track and keep the family solvent. You probably know that you should make a list of the gifts you need to buy and budget what you need to spend. But what can slip by are all the expenses that aren't wrapped up. It's the holiday incidentals that can sink a budget. Your list should include wrapping supplies and mailing expenses, decorations, baking supplies for the holiday goodies and meals, tips for service people like the mailman, the paper delivery boy, and the dog groomer, donations to charities, and if you'll be visiting families out of town, include those travel expenses as well. Determine if the amount you've estimated is what you really can afford. Do you have the cash on hand, or will you be using a credit card? When you charge something to a credit card, try the trick of deducting the amount from your checkbook balance when you make the purchase. Then when the bill arrives, you'll know the money's there. If you will be carrying credit card debt, try to get a handle on how the bills will affect your budget come January. Under normal conditions, your monthly credit payments, excluding your mortgage payment, should not exceed 15% of your take-home pay. Take some time to get a handle on your budget to keep your family from entering the new millennium mired in holiday debt. That's your Saturday Savings Tip. I'm Janet Marcantonio. And most companies will not only charge the fee, but also raise the interest rate when payment is late. Unwary card users could get caught in a real trap. Here's how. Say you missed the due date on your monthly payment. The card issuer slaps you with a $29 late payment fee and raises your interest from 9.9% to 15%. The higher interest rate nearly doubles the finance charges that are added to your balance each month. That pushes you over the credit limit, resulting in a $29 over-the-limit fee as well. Worse yet, let's say you miss a due date twice in 6 months. The interest rate goes up to 21%. Between the fees and higher interest rate, as long as you make only the minimum payment, you may never reduce the original debt. You could go on paying finance charges and fees forever. So to avoid such traps, ask your credit card company for its fee disclosure schedule that reveals all charges. And make note of your payment due date. Most card issuers allow 10 days for mail delivery and processing of your payment. And finally, be aware of your credit limit. Preempt an over-the-limit situation by calling the card issuer and asking if you qualify for a credit increase. That's your Saturday Savings Tip. I'm Janet Marcantonio.
So is it better to buy or lease? Financial planner Janet Marcantonio sorts it all out in Saturday Savings.
If you're in the market for a new car, you're probably well aware that there's a slew of options for financing your new wheels. The first question many wrestle with is to lease or buy. Well, here are some guidelines that may help. In the long run, buying a car is generally cheaper. If you're cost conscious, you can continue driving your fully paid car after the monthly payments have stopped. At the end of a lease, you must make a substantial payment to own the car or start all over with monthly payments on a new lease. You never own your car. So as a rule of thumb, if you keep your cars for more than 6 years or you drive over 15,000 miles per year, you should buy. But there are a lot of good reasons to lease. If you don't have enough money for a down payment and want to keep monthly payments low, a lease is the way to go. It can also help you drive a more expensive car than you can afford otherwise. Here's an example of the difference in the cash outlay. Take a 1999 Acura Integra with a sales price of $18,000. If you buy, your down payment would generally be 20% or $3,600 versus 5% or $900 if you lease. If you buy, you pay a sales tax of $1,260. There is no sales tax if you lease. And if you buy, your monthly payment would be $395 versus $245 if you lease. But a crucial consideration in leasing is how many miles you drive per year. Generally, there's an allowance of anywhere from 12,000 to 20,000 miles per year before a per mile fee kicks in. So check your monthly mileage, and if it's less than 1,000 miles, then a lease is a good choice. Finally, tax laws favor leases for business people who deduct car expenses on their tax returns. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Most of us have liability insurance on both our homes and cars, but is it enough? If you're not sure, then you may want to consider the extra coverage of an umbrella policy. Financial planner Janet Marcantonio has the details in this week's Saturday Savings.
Personal liability policies are among the best buys in insurance today. Commonly known as umbrella policies, they're relatively cheap, costing less than $300 a year for $1 million in liability coverage. These policies act as an umbrella to provide extra coverage over and above the liability limit of your home and auto policy. Typically, you need to be already insured for $300,000 of liability coverage on your home or auto policy to qualify for an umbrella policy. If you're worth less than $300,000, you may mistakenly think your auto policy gives you enough protection with its $300,000 liability limit per accident. But that same policy may give you only $25,000 cap for property damage that you cause. There are a lot of cars worth more than $25,000. If you have an accident where you hit more than one car, you may need an umbrella. An umbrella is a separate policy and not restricted to incidents involving your car or home. Umbrella policies raise the liability limits if you have to pay damages from a lawsuit or if you incur costs to fight such a suit. Both Bill Clinton and O.J. Simpson had personal liability policies that paid part of their legal bills in their civil cases. But you certainly don't need to be rich to be sued. Just own a swimming pool or an aggressive dog. Even if you're convinced that you will never be sued, an umbrella policy can still be a godsend. Picture an uninsured driver plowing into you at a red light or hitting your child while he's riding a bicycle. Those are the times you'll want an umbrella. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Long before the tax man will be calling, Janet Marcantonio has helpful tips now to lighten your tax liability.
Although this year-end may seem different with all the hoopla of the new millennium, the tax man views December 31st, 1999 as any other. It's a deadline for determining your tax liability. So here are some last-minute strategies for lightening the tax load. It's the time of year for giving, so be charitable. Empty your house of old clothes, furniture, and other garage sale items. Make an inventory and take pictures for your records and estimate their fair market value. Then donate them to your favorite charity to claim a charitable deduction. Remember that items over $250 require a receipt. And harvest your portfolio losses. You may want to sell your losers to offset any gains. You can buy back the same stock or mutual fund without breaking IRS rules if you wait 30 days. Or you can immediately replace the loser with a similar stock or fund so that your portfolio remains well balanced after a tax selling move. In addition to offsetting all your gains, you can offset up to $3,000 of ordinary income with investment losses. Prepay taxes and mortgage interest. Consider paying your fourth quarter state income tax estimate and prepay your January mortgage payment this year. Pay your second property tax installment due in 2000 by the end of 1999. But just as prepayment can increase your deductions for 1999, remember that it may reduce your deductions for 2000. Finally, we may now begin dealing with a kinder and gentler IRS, but most deductions simply will not fly without substantiation. So keep carefully documented records of all income and expenses. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Choices out there, you may not know exactly how each one is different or which one is best for you. Janet Marcantonio is here to take the confusion and mystery out of one of those choices, annuities.
Never underestimate the power of a tax break to make investors behave irrationally. Americans poured over $90 billion into tax-deferred annuities last year, yet half of those sales were to people who didn't even need them, namely retirees. Annuities are just complex enough to make it hard for most people to weigh the costs and benefits. Most simply, an annuity is an investment contract wrapped in an insurance policy. Investors pay either a lump sum or periodic installments to buy an annuity. With a variable annuity, you essentially are investing in mutual funds. You can choose among several funds and move your money from one to another. Your gains are tax deferred until you draw the money out. If you want a tax deferral and you're investing with your money in your IRA or other retirement plan, you don't need an annuity. Yes, annuities are tax deferred, but so is your retirement plan. So why pay for this advantage twice? Variable annuities are hard to justify for older people who are investing with taxable income as well. Earnings withdrawn from an annuity are taxed as ordinary income, while earnings withdrawn from your mutual funds outside an annuity are taxed the lower capital gains rate. You have to hold a variable annuity for 12 to 20 years or more before your gains from tax deferral outweigh the higher taxes and much higher fees you have to pay with an annuity. The lower your tax bracket, the longer you have to wait. Variable annuities often make sense for younger people in higher tax brackets, looking for a supplement to their retirement savings. But once you have one, don't switch from one variable annuity to another. The only one who will benefit is the salesperson. That's your Saturday Savings Tip. I'm Janet Marcantonio.
And no one likes to think about death, but having a will set aside just in case is important. Financial planner Janet Marcantonio explains why in today's Saturday Savings.
When was the last time you updated your will? Or do you even have a will? If you don't, you're not alone. In fact, you're in the majority. But you should know that if you don't have a will, the state of Rhode Island, or whichever state you live in, has one for you. The state will decide where your assets go, and you may not like the results. Granted, you'll be gone, but your family will have to live with the consequences. Following state law, if you die without a will, the courts will rely on the rules of descent, which are very inflexible. Some of the consequences of dying without a will may be that your spouse may not get your entire estate. He or she may have to share it with your parents, your siblings, or your children, even from a previous marriage. Your children are entitled by law to receive their inheritance at age 18, not at a time in life when you think they may be better prepared to handle the responsibilities. A probate judge will appoint a guardian for your children if they're minors, and an administrator for your estate. Your estate pays for those appointments, neither of which may be your first choice. Finally, without a plan to minimize taxes, your estate may be subject to unnecessary inheritance taxes. A will reduces court time and attorney's fees. Spending less money on avoidable expenses means you'll leave more for your heirs. In short, a will gives you the power to preserve your estate and direct where your assets will go. You earned it. You should decide what happens to it, not the state. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Money management and how young is too young to start investing. Financial planner Janet Marcantonio has some answers in today's Saturday Savings.
Most kids are pros when it comes to spending money, but managing it's another story. According to the American Savings Education Council, 2/3 of students ages 16 to 22 admit they should know more about money management. 94% of students cited that their parents are the main source of information. So with home as the most likely place for kids to get their basic training in money management, here's how you can get them started. Talk about where money comes from and where it goes. Even at an early age, kids can gain an appreciation that spending is about choice and compromise. The most basic lesson is that there's a limited supply of money from which to satisfy everyone's wants and needs. Not only toys and candy, but the roof over your head, groceries, and more. An allowance can teach kids about the keystones of money management: spending, budgeting, and sacrificing a little now for something larger later. Make clear what expenses your kids will be expected to cover from their allowance, and make those expenses age appropriate, whether it's making your 8-year-old pay for his own Pokemon cards or your 12-year-old paying to go to the movies with friends. But don't put too much money in the child's control, such as the budget for school lunches and clothing. You may find yourself having to rescue your kid from bad judgment. To encourage saving, you may want to offer to match each dollar your child saves during the course of a year, kind of like a kid 401k. That can encourage them to save for a long-term goal, such as a car, and exercise some self-control over impulse buying. That's your Saturday savings tip. I'm Janet Marcantonio.
Special Sunday savings, Janet Marcantonio has tips on tipping.
Tipping isn't just a restaurant issue anymore, with some 30 kinds of service professionals staff.
A special Sunday savings, Janet Marcantonio has tips on tipping.
Tipping isn't just a restaurant issue anymore, with some 30 kinds of service professionals supplementing their income with gratuities. Tipping has become, by some estimates, a $16 billion industry. That means you not only need to know what to tip, but you need to figure it into your budget as well. The word tip comes from the acronym to ensure promptness. So when a waiter delivers prompt service, you should promptly leave the standard tip of 15 to 20%. If your dining experience was terrible, scale back on the tip only to the degree that it was within the waiter's control. If the food was terrible or the restaurant was noisy, complain to management, but don't penalize the wait staff. And what about other restaurant personnel? Well, it's not necessary to tip the maitre d' unless special service was provided, and then about $5. Also customary is $1 per coat to the coat check attendant and $2 to $5 for valet parking. 15% is pretty much the standard for your hair salon or barbershop operator and the manicurist. Same goes for the taxi driver. For the pizza delivery person, $2 to $3 is appropriate. But for large deliveries of any kind, such as furniture and appliances, $5 to $10 is the minimum. If delivery is particularly heavy or requires assembly, a larger tip of perhaps $20 is suggested. When you're traveling, tips come with the territory. On top of your hotel room, be sure to budget 15% for room service, $2 per day for the chambermaid, $1 per bag for the bellhop, and $1 for the doorman to hail a cab. Tips can add 20% to the cost of a cruise. If you're planning recreational activities, a golf caddy gets as much as 25% of the greens fees. And guides on bus trips and tours expect a 10 to 20% tip at the end of a trip. If you don't know what's expected, ask. That's especially true when you're traveling abroad. Taking time to find out what's customary can save you an embarrassing moment or two. That's your savings tip. I'm Janet Marcantonio.
Still ahead, Fred has a full look at the forecast for the rest of today.
Janet Marcantonio has some tips for the stock market to help you push forward in the new millennium.
Reserved for the executive suite, but that's no longer the case, with more and more companies handing out stock options to the rank and file as well. By some estimates, employees control 8.3% of the total stock of U.S. corporations, or $663 billion, and employee stock options plans account for at least $200 billion of that total. It's becoming increasingly popular for a company to award employees with stock options as an incentive for continued performance and loyalty. An employee stock option gives you the right to buy a certain number of shares of your employer's stock at a stated price over a certain period of time. The purchase or exercise price is usually equal to the stock market's price at the time that the option is granted to the employee. Generally, there's a minimum amount of time that the employee must wait after the option is granted before it can be exercised or purchased. Employees profit if they can sell their stock for more than they paid for it. And there are three main ways to exercise options. You can pay cash, swap company stock you already own, or borrow money from a stockbroker while simultaneously selling enough shares to cover your costs. It's usually smart to hold options as long as you can before exercising them, to give the stock time to appreciate and maximize your overall gain. Most companies give you from 5 to 10 years to exercise the options before they expire. The tax consequences can be tricky depending on the type of stock option. So if you're lucky enough to be awarded employee stock options, carefully read all the information provided by your company's benefits department, and then sit back and enjoy this executive perk that's no longer just for executives. That's your Saturday savings tip. I'm Janet Marcantonio.
To the less risky bond market as they get older. But is that the right choice for you? Find out in today's Saturday Savings.
At the time of retirement, many people will begin to shift more of their investments from stocks to bonds. That's because bonds are considered to be more conservative than stocks. As opposed to stocks, you're guaranteed your return of principal as long as you hold a bond to maturity. And in the meantime, you also receive a steady stream of interest income. But that's not to say there's no risk involved with investing in bonds. In fact, there are a number of risks that can affect your return from bonds, the most important of which is interest rate risk. When you invest in a bond or even certificate of deposit, you're guaranteed income based on the interest rate at the time of investment until the bond or CD matures. But what happens if interest rates are lower when the bond matures? Well, you'll have no choice but to reinvest it at the lower interest rate, and your income will go down along with it. The solution is to build a ladder of bonds. Here's how it works. You buy equal amounts of bonds for each rung of your ladder, maturing in a different year, from 1 year right up to 10 years. When the first bond matures in 1 year, you reinvest the money in a new 10-year bond. In this way, you always have more money to reinvest every year. If rates do go up, you can take comfort in the fact that you'll have more money coming available to take advantage of the change. And similarly, if rates decline, you've managed to lock in the higher rates for a good portion of your portfolio. The bottom line is, you won't get stuck one way or the other. That's your Saturday Savings Tip. I'm Janet Marcantonio.
For almost every family. When is something worth going into debt for, and is there a good type of debt? Janet Marcantonio has details on the debt debate in today's Saturday Savings.
With the total credit card debt of Americans approaching $600 billion, it's no surprise to hear that the average American household is struggling to keep debt under control. The key to managing debt is to first distinguish good debt from bad debt. Good debt includes anything that you really need but can't afford without wiping out cash reserves or liquidating investments. And it's good debt only if you can afford the payment. Let's consider the merits of borrowing for three major necessities. First, the chance that you can avoid debt altogether by paying cash for a new home is probably nil. Your focus should be to consider carefully how much to put down versus how much of a loan you can afford. Plunking down every available dime to cut your interest payments is not always the best move. Consider your need for cash reserves as well as what your investments are earning, your age, and income prospects. Some mortgage lenders require as little as 5% down, but the drawback is if you put down less than 20%, you'll have to buy private mortgage insurance. And since new cars tend to plummet in value as soon as you drive them off the lot, financing a car often makes sense. Approach financing as you would a house. Look for the best rate available. If you're tempted to use a home equity loan to buy a car, be sure to boost your monthly payments so the loan will be paid off while you still have the car. Finally, if you've decided that you're willing to pay for your children's education, borrowing makes more sense than liquidating your retirement funds. Your best bet is to let your kids borrow, especially if they're eligible for a government-backed Perkins or Stafford loan. With its guaranteed low rates and no interest payments until after graduation, you'll come out far ahead over borrowing against your home or 401k. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Well, Fred's full forecast is coming up next on ABC6 Weekend. Find out how long and
tax time, and if you're thinking about getting some professional help making it through these taxing times, Janet Marcantonio has what you need to know now in today's Saturday Savings.
While many people insist on preparing their own tax return, others would rather leave it to a professional. If you're in the latter category, you may have had trouble distinguishing between the types of individuals who prepare tax returns for a fee. The first question to answer is, how complex is your return? If yours is a two-income family and both taxpayers have been on the job all year, you've earned no outside income, and you own no rental property, then your return can be handled by any competent tax preparer. On the other hand, if you're self-employed, own a small business, have fluctuating income, or fall within a high-income bracket, you might be better off with a certified public accountant. CPA's fees are often higher because of their credentials. They have to meet minimum requirements for education and professional work experience and pass rigorous examinations. By contrast, most returns prepared by the large tax preparation firms are done by non-CPAs with a college degree and a year or so on the job. While qualified tax preparers can competently complete your return, a good CPA can offer you taxation strategies for tax savings, including retirement savings, capital gains on the sale of a home, or tax issues stemming from divorce. And if you're self-employed, They can advise you about how to make your accounting systems and benefit plans more tax-friendly. If you do plan to hire a CPA, ask whether they're members of the American Institute of Certified Public Accountants. Members are subject to peer review and a strict code of ethics. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Well, there's finally some good news for people who enjoy eggs, struggling on a fixed income. Is it right for you? Janet Marcantonio has more now in Saturday Savings.
With the possible exception of a 401k, for most of us, our house is the biggest asset we own. In fact, many older Americans are house rich, but struggling to live on a low fixed income. Others may just face the prospect of mounting home health care expenses. These are just two reasons the reverse mortgage has become popular in recent years. It's a means for older Americans who have fallen short of their retirement savings goals to squeeze the money out of the assets they did manage to amass, their home. If you're 62 years of age or older, a reverse mortgage allows you to take out a loan on the equity left in your home, either for a fixed term or for the rest of your life. It's called a reverse mortgage because the lender actually makes monthly payments to you. You may even receive a lump sum cash payment or a line of credit. The amount the lender will pay is based on the amount of equity in your home, the interest rate, the term of your life expectancy, and the expected appreciation of your house. You get to continue living in the home for as long as the loan continues. Then when you move or die, the mortgage company either reclaims the property and sells it to repay the loan, or you may allow your children to step up and keep the house by taking out a new forward or traditional mortgage. The money from a reverse mortgage is tax-free because it's considered a loan, but there are some serious drawbacks. Reverse mortgages come with high upfront fees. Closing costs typically amount to 4 to 8%, and there is a limit to the amount that can be financed. As a result, a reverse mortgage often doesn't provide the stream of income you'd expect. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Well, Fred's full force on the minds of many families, but did you know that money saved in a child's name may have a different value than money saved in a parent's name? Here's Janet Marcantonio to explain how you can get the most out of your tuition savings.
Many parents want to save as much as they can for their children's education. At a time when schools are inundated with financial aid requests, a student who has a greater ability to pay tuition will be able to apply to a wider selection of schools. But what's the best way to save? Well, generally, if you're in a high-income bracket, many experts suggest saving money in your child's name. That's because interest or dividends earned on those invested savings will be taxed as income to your child at a lower tax bracket. The impact can be anywhere from 13 to 24% less taxes paid. But if there's a chance at all of qualifying for financial aid, it's best to keep all savings in the parent's name. There's a federal formula that's applied to determine qualifications for financial aid, and it looks at assets in students' names differently than those in a parent's name. The impact is simple and profound. 35% of a student's assets are assessed to pay tuition, whereas only 6% of a parent's assets are considered available to foot the bill. For example, if $5,000 has been saved in a student's name and that amount entered on the financial aid form under student assets, the family contribution level will be $1,750, as opposed to only $300 if the money had been saved in the parent's name. So even if you are in a high-income bracket, if you have several children to put through college, you may very likely qualify for aid when the time comes. Consider consulting a qualified financial planner to determine the best way for your family to save. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Well, there may be some good news for those of you who played at the polls. Record numbers of absentee ballots have already been cast, pointing out to a heavy turnout. Both John McCain and George W. Bush are predicting victory. And it's a hassle that thankfully only happens once a year, filing your taxes. But now there are different ways to fill out your tax returns. But what method is right for you? Our financial planner, Janet Marcantonio, will sort it all out in this week's Saturday Savings.
The Internal Revenue Service is eager to get more and more Americans using the IRS e-file program. That's the electronic filing of your tax returns. IRS e-file is touted to be a quick, easy, and accurate alternative to traditional paper returns. You can get your refund in half the time and even faster if you use direct deposit. The IRS says your chance of getting an error notice from them is significantly reduced because IRS e-file is more accurate than mailing a paper return. You get proof that the IRS has accepted your return within 48 hours, and your privacy and security are assured. You can even make your payments electronically if you have a balance due by using direct debit from your checking or savings account or a credit card. When you file electronically, you have the option to file now and pay later, up to the day tax returns are due. There are several options for e-file, including filing through a tax professional, through your personal computer, or over the telephone. Telefile, which is filing your return over the telephone, is only available to those who get the Telefile tax booklet in the mail. If you prepare your own tax return using one of those computer software programs like TurboTax, you can file your return through their electronic service. Depending on which software program you use, you'll need a modem and/or internet access. Visit the IRS website at www.irs.gov to find a list of online filing companies or to search for tax professionals near you who are authorized IRS e-file providers. That's your Saturday Savings Tips. I'm Janet Marcantonio.
Medical experts make a call to the wild for new treatment for arthritis sufferers, and diabetic options come to mind, including an IRA account. Now there are different IRAs designed to meet your specific needs. Here's Janet Marcantonio now to help you determine which IRA is right for you.
An individual retirement account allows you to then invest up to $2,000 a year towards your future. If you're eligible, you have until April 15th to open an IRA for $19.99. So carefully consider your options and the rules. First, there's the traditional IRA, which allows you to subtract the amount of your contribution from your total income at tax time. You don't pay taxes on that money until you begin taking it out at retirement. There are rules governing when you can and have to take money out. Generally, you have to be 59 and a half or older to avoid a 10% penalty on the amount you withdraw. And you have to begin withdrawing minimum amounts of it by April 1st after the year you turn 70 and a half. If you're not covered by a company plan at work, you're eligible to contribute up to $2,000 into a traditional IRA. Even if you are covered by a plan at work but earn less than $30,000 a year, you still may contribute a limited amount to a traditional IRA. Then there's the Roth IRA. That's where you can put $2,000 in, but you don't get a tax write-off. The good news is that because you pay taxes on this money as part of your earnings, you have total access to the contributions at any time without penalty or taxes. Only the earnings and interest on your contribution to a Roth IRA have to stay in the account until you're 59 and a half or at least 5 years. If you're single with adjusted gross income of $95,000 or less, or married with an AGI of $150,000 or less, you're eligible to contribute the full $2,000 to a Roth IRA, regardless of whether you participate in a retirement plan at work or not. For almost everyone, the Roth IRA is a great choice. That's your Saturday Savings Tip. I'm Janet Marcantonio.
New implant surgery is the answer to what interest may be eaten up by some hidden costs. Even if you own a no-load mutual fund, you'll want to listen up. Janet Marcantonio is here now to help you figure out what those costs are and how they can affect your balance.
Many people are under the impression that a no-load mutual fund means that they pay no fees to invest in that fund. While it's true that a no-load mutual fund doesn't charge a sales commission, there are guaranteed to be other costs to owning that fund. So how do you figure out what those costs are? Well, anytime you invest in a mutual fund, you should be given a prospectus for that fund. The prospectus is the fund's selling document that contains information about costs, risk, past performance, and the fund's investment goals. Near the front of the prospectus, you'll find the fee table, which lays out the fund's costs. You can use that table to compare the costs of different funds. The first part of the fee table will tell you if the fund charges any sales loads. A sales load is a fee that's charged to pay a commission to the people who sell the fund, as well as other marketing costs. Sales loads buy you a broker's services and advice. They don't assure superior performance. The sales load charged may be a front-end or back-end load, meaning simply that you pay at the front end when you buy the funds or at the back end when you sell the funds. The second part of the fee table tells you the kinds of ongoing expenses you'll pay while you remain invested in the fund. There will always be a management fee, which pays for managing the fund's portfolio, along with any other fees and expenses. Shop wisely before selecting a mutual fund. Compare fees and expenses and net investment return. Because remember, a fund that has a sales load and high expenses will have to perform better than a low-cost fund just to stay even.
Determine whether or not they'll do business with you? We have the answer and secrets you need to know for looking good to lenders in this week's Saturday Savings.
For years, lenders have been using credit scoring to determine if you'd be a good risk for credit cards, auto loans, and even home mortgages. Here's how it works. Personal and credit information is collected from a credit application and your credit report. Points are awarded for each factor that helps predict debt repayment. A total number of points, your credit score, helps predict your chances of repaying a loan and making payments when due. Payment history is a significant factor. If you've paid bills late, had an account referred to collections, or declared bankruptcy, it may negatively affect the score. The amount of your outstanding debt is also evaluated. If the amount you owe is close to your limit on credit cards, it could negatively impact the score. The length of your credit history is another factor. If you've applied for too many new accounts recently, that may negatively affect it. The number and types of credit accounts you already have are also evaluated. Finally, your occupation, length of employment, and whether you own a home can influence your credit score. Credit scoring models vary among lenders for different types of credit, and only the creditor can explain what might improve your score under their particular model. Don't be afraid to ask how to improve your application. That's your Saturday Savings Tip. I'm Janet Marcantonio.
All right, thanks, Janet. A new federally approved drug could...
Thinking about retirement and saving for it, too. Our financial planner, Janet Marcantonio, has some tips to make sure your golden years shine.
A single month at a nursing home today costs an average of $5,000. With the very thought of long-term care so daunting, many retirees have turned to long-term care insurance to cover the potential costs. So how do you know if long-term care insurance is for you? Well, generally, if you meet any two of the three following criteria, then a long-term care policy should be considered. The first guideline is if you have more than $150,000 but less than $450,000 worth of retirement assets, including your home. If assets are less, you may qualify for Medicaid should you require more than several months of skilled nursing care. If you have more than $450,000, you'll be better off employing an investment strategy to pay for your own care. The second consideration is preserving what remains of your assets for your heirs, especially if you're concerned about one particular surviving member, such as a disabled child or a son or daughter who's a single parent. The third and most perhaps important consideration is if you have reason to believe you'll require long-term care but don't yet have a specific diagnosed condition, such as Alzheimer's disease, that would prevent you from getting insurance. If you think long-term care insurance makes sense for you, look into the policies of only AAA-rated insurance companies and compare the costs and benefits before buying. That's your Saturday Savings Tip. I'm Janet Marcantonio. In this decade, many will squander their inheritance. Some may even quit their jobs with delusions of how far it will carry them. To avoid such mistakes, consider these guidelines for approaching a windfall. Start by listing all the things you'd like to accomplish. If you want to have some frivolous fun, limit yourself to 5%. Then rough out a budget and determine how much of your windfall will go toward current expenses. If you haven't been putting much into your company's 401k, increase your payroll deduction to the maximum and use your inheritance to fill the gap in your take-home pay. If it's a modest inheritance of, say, less than $75,000, pay off credit card debt and invest for your children's education or supplement your retirement savings. If it's a larger inheritance of up to $500,000, you can afford some extra splurges like big vacations. But don't quit your job unless you have other sources of income. With a major inheritance of $1 million or more, you may be able to retire early. You might change careers or simply raise your standard of living. Keep some of your inheritance in cash for emergencies and divide the rest between stocks and bonds, either in mutual funds or individual securities. To make a well-invested portfolio last for life, withdraw no more than 5% each year. And finally, don't touch an inherited IRA until you consulted a financial advisor. How much tax you pay will depend on how you draw that money out. That's your Saturday Savings Tip. I'm Janet Marcantonio.
Contact lenses may help you see, but can they be putting you at star Reggie Lewis took the Whitman alone keeping track of all your records. So how long should you keep those tax documents, and what statements can you file in the trash? Janet Marcantonio has the answers in this week's Saturday Savings.
As this weekend officially signals the end of tax season, you'll probably file away a copy of your income tax return for your own records, as you more than likely have done in past years. But at some point, you may ask, how long should you keep those records? Well, the federal tax laws require you to maintain records to support amounts reported on your tax returns for as long as they may be relevant to your claim as a tax credit or refund, or to an IRS attempt to assess additional tax for a particular year in question. The specific rules are quite detailed, but here are some general guidelines. Keep your tax returns forever to prove to the IRS that you filed. To be safe, most supporting documents, including bank and investment statements, proof of deductions, such as charity receipts, pertinent sales receipts and canceled checks, and employee expense reports relating to travel and entertainment expenses should be kept for 6 years. Also keep records of anything of value you may sell later, including collectibles, stocks and bonds, and jewelry. Generally, the IRS has up to 3 years to enact an audit. If the IRS suspects income has been understated by greater than 25%, they have up to 6 years to perform an audit. And there's no statute of limitations for fraudulent filings. Keep these records where you know you can find them. A file cabinet will do for most papers. Receipts for high-cost items or anything you may have difficulty replacing in the event of a disaster belong in a fireproof safe or a safe deposit box. That's your Saturday Savings Tip.